Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. I'm Barry Schwartz, and I'm joined by Ernest Wong, Head of Research at Baskin Wealth. Thank you for joining us today. The date is Wednesday, April 16th. A week ago, we did a podcast about the market in turmoil, the tariffs that were happening, and I think an hour after we recorded the podcast, Ernest, the stock market went up about, 16%? Something like that?
I think it was 10%.
10%, some crazy amount in a very short period of time as Trump announced he was pausing the tariffs. Then we had some confusing news on the weekend, of course, where the Trump administration looked like it was going to put Apple iPhones and NVIDIA chips and semiconductor chips under a much lower tariff. And then, of course, it looks like he walked some of that back. I mean, it's all very confusing and flip-flopping. So I guess we'll get into more tariff stuff. We'll talk about our strategy for investing, why we don't make extreme changes in periods of heightened volatility, why defensive stocks may look appealing in a downturn, but may not necessarily be the right time to buy them. And we'll do a little more discussion about the market conditions. So thank you so much for joining us. As always, if you like this podcast, please subscribe to it on YouTube, on Apple, as well as Spotify. We would really love if you would subscribe, as well as give us a 5-star review if you like this podcast, and share and tell your friends. Ernest, how's your week going?
Going as well as it could.
Ernest is trying not to look at the stock market. I look at the stock market, so sometimes it's regrettable. What's the story in the Bible where you looked back and you turned into a pillar of salt?
Hopefully, I think we're not there yet.
No, so it's not Sodom and Gomorrah yet, but sometimes it feels, we totally get the concerns everybody has. I think we mentioned on the podcast last week, there isn't going to be some specific catalyst to take the market higher unless Trump pauses all or stops all tariffs. We have the Federal Reserve speaking today, Jerome Powell. He's mentioning that there's really no reason for them to take any action yet because they don't know how bad it's going to be and what the impacts are going to be as well. Bank of Canada today, same thing. They didn't cut interest rates after cutting interest rates for 7 meetings in a row. Really want to see how things play out. I think a lot of people, Ernest, are worried that tariffs cause inflation, which should be true. So what's your take on, and we were talking before we started about, for example, about Ferrari and how it can offset its tariffs and some of the things that it's doing. And so what's your take on, I guess, the tariffs? Yes, no, good, bad?
Well, I think the market's going to do what it's going to do. Mm-hmm. It's going to go up or down on any given day due to the news and maybe what Trump is tweeting on Truth Social or what Jerome Powell is talking about. But I think the real issue in the markets today, and I think we'll probably see more of this in the coming weeks as companies report earnings, is that I think companies really don't know what to do because
neither do investors.
They don't know what to do in the sense that, let's say you're General Motors. You're potentially facing a tariff on your cars from that are manufactured in Mexico or Canada to bring into the United States. So, okay, do you move your plant or not? Right? Like Trump seems to change his mind every day on do I exempt cars that are eligible for like the USMCA agreement. Maybe we're pausing auto tariffs, or maybe we're not because we got to bring back American manufacturing.
So let's say we're running GM. We're the co-CEOs of GM. Everything's going along fine. And then we get these announcements that there's going to be 25% tariffs on autos, tariffs on steel and aluminum. We make all our cars in other countries because that's where we can source the inputs at low prices. We've already committed billions and billions of dollars making those plants, manufacturing, hiring workers, buying the machinery, the tooling, and then all of a sudden we have to move our plants. How can we even do that? We have to find workers. We have to find locations. We have to make sure we have supplies and inputs, as well as we have shareholders and stakeholders that we have to treat well. We're paying them a dividend right now. Do we stop our dividend? How does this impact our balance sheet? Meanwhile, if prices of cars go up because we have to raise prices, then demand's going to slow. So, we're worried now about maybe our cash flow. It's not a scenario where you can make any hard and fast decisions.
And that's especially true for something like an auto plant, which takes years to plan in advance.
Yeah.
And you don't want to have spent all that money to move to a higher cost manufacturing location. And then maybe Trump is not the president anymore. Yeah. And the next president of the United States says, yeah, we want free trade again.
Yeah.
So I think that's really the challenging environment that companies are going through today.
Yeah. So I think I said a few podcasts ago that this scenario is maybe nothing like the pandemic, but starting to think it is quite similar because the visibility that companies have is nothing.
No, and I think in more ways than one as well. I think we saw reports on the weekend that people are starting to panic buy iPhones.
Yeah.
Like they're worried that iPhone prices are going up. They see the headlines about Apple, in the newspaper or on TV. Mm-hmm. And they want to buy their iPhones before the price goes up.
Yeah.
So very similar to the March 2020 period when people were worried that there wasn't going to be enough toilet paper or wheat flour or anything like that. And people were trying to get ahead of that. And I think it's going to create I think on the one hand, it's great for Apple because, people still want to buy iPhones.
Yes.
Right. So, but
we don't have a demand problem, Ernest.
Yeah.
We don't have a demand problem right now in the world. We still have good growth. We have huge, like the U.S. blocking. I don't know what exactly they proclaim to NVIDIA, but NVIDIA is not allowed to sell specific chips at the moment to China. There's huge demand for these chips. They're sold out. There was $5.5 billion of these chips that were pre-committed and sold to China that they can have to say, sorry, we can't sell you these chips right now. Maybe never.
Right.
Yeah.
And no, I think that's for someone like Apple, for instance, right? There's going to be a lot of distortions in terms of their financial results again over the next couple of years because, so we already know that this coming quarter is probably going to be pretty strong because people were panic buying iPhones in advance of tariffs. But then like maybe next quarter and then through to next year, people already upgraded their iPhones.
Yes.
So sales are going to fall. And then they're going to say, well, that's because to use investment language, like the comps were poor, right? So I think it's a messy time both for business and from like an investment analysis perspective as well.
It's very hard. There's a fog across the world right now in terms of visibility. I think we'll find out in the next few weeks as companies, especially the big tech companies, start reporting their earnings. I assume that they will just pull their guidance or not give any guidance. What's the point? We saw something I've never seen before from United Airlines last night reporting its earnings, saying that, well, under scenario A, where everything comes back to normal, we're going to make a bunch of money. Under scenario B, this continues and there's tariffs and there's a slowdown and a recession. Here's how much money we're going to make, but we'll still be fine. Hard to know. So the longer this goes on, of course, the more concerning it is for the short term. And of course, the stock market is reacting to these things. We had a huge run up, of course, last Wednesday after we recorded this podcast, and some few good days after that. Today, of course, not looking like such a good day after the NVIDIA news, where the U.S. is not allowing those chips from NVIDIA or AMD to be sold to China. as this trade war, which it is, escalates, and essentially it's become a trade embargo. I don't think I've ever seen tariffs this high on countries, and so it really causes, as everybody's been saying, chaos. So in this chaos, Ernest, we're saying we don't have visibility right now in the short term. Everybody is concerned. There's so much heightened uncertainty. It's the natural question is, okay, so what can we do to protect our portfolio, right? What can we do to stop the bleeding in the short term, right? When you have an injury and you hurt yourself, you want to take care of that injury. You want to stop the bleeding. You want to put ice on it. You want to stop doing what you're doing. But in investing, it doesn't work like that, right? You can stop doing what you're doing, but that means making a binary decision that today's the day that I'm going to make all these wide changes, even though I know the news is going to continue to get worse. So that's kind of the conundrum that short-term investors are in. As long-term investors, there's no pressure on us to make any changes to our portfolio. We don't have to change our process whatsoever. In fact, this can lead to great opportunities if we feel the world eventually returns to a more normalized environment.
Yeah, I think the counterintuitive thing about investing is that whatever feels most uncomfortable to do at the moment is probably what ends up being the most profitable. And whatever feels like the safest thing to do, and at a certain time, and usually you feel that way because things are, there's things to worry about, like tariffs or COVID or whatever.
So let's get into specific examples. I've been in the business since 2000. I'll reference 2008, 2009. The worst actors in the 2008, 2009 crisis were the financials.
Yeah.
We thought Lehman Brothers had gone bankrupt. AIG had serious commitments to Lehman Brothers. Everybody thought all the banks were going to go bankrupt. Their stocks got killed. You wouldn't want to touch financials forever.
Yep.
That turned out to be the best time to buy them. Give the example of oil in the pandemic.
No, I think I think the more, so for oil, and I remember this very clearly because we were seriously discussing these names at that time. But in 2020 to 2021, crude oil was trading around $40 per barrel. And that's basically at a level that no oil producer is making any money, right? There was nothing positive for oil, right? The economy was bad. China was bad. China was in lockdown.
The economy was, there was no planes flying in the sky. Remember, the environment healed for a bit.
Yeah.
The pollution dropped and it was dead.
Yep.
Yeah.
And in the US, you had like shale drillers being kind of price insensitive about ramping up drilling, right? So there was really no bull case for oil or oil stocks. But that turned out to be a generational time to buy oil stocks. You would have made many times your money if you bought oil stocks at that time. On the flip side, I think there's plenty of examples where chasing safety or buying what you think you missed because it is working well at that moment doesn't end up working, right? So the obvious examples would be in buying tech stocks in 1999, right? Or buying like COVID winners in 2021, like companies like Peloton, or even like a more recent example is buying defensive consumer staples or energy stocks in 2022 when inflation was going through the roof, oil prices had soared and were at all-time highs. Like consumer staples like Pepsi were raising prices and their shares were not falling like the tech stocks, right? Yeah. And so it was very easy for an investor to go in at that time and say, I think my portfolio was overweighted to tech stocks and I should have just owned more consumer staples. So we should sell tech and buy consumer staples.
Rotating into consumer staples, which are, as Ernest laid out, are companies that sell products that people cannot live without, right? The grocery stores, the utilities, food companies. We all have to eat, right? But that's not buying those names isn't an investment thesis. It's really, oh, I can't take the bleeding anymore, so let's jump into the names that probably will hold up better in a recession, in a very bad market. The problem, as you pointed out with that thinking, is everybody else is thinking that too. And it's not like the shares of those companies are trading at a discount. When we look at some of the Canadian grocery stores, for example, they're trading at the highest multiples of valuation ever. We look at Coca-Cola, for example, trading at an extreme valuation for companies that essentially have no growth. These are companies that grow with inflation and GDP.
No,
And then not even, and probably took too much pricing over the last few years and at risk for the pricing of their products to fall significantly.
no, and I want to bring this to an example that we have in the portfolio where, so TFI International, right? They are a trucking provider, clearly highly impacted by a cyclical downturn, like if there's a recession, and very impacted by tariffs, right? Stocks down, I want to say like
50% from
almost down 50%. And so it's very easy to say like, well, why don't we just sell TFI stock, cut the bleeding, makes us feel good because we don't have a loser in the portfolio anymore. And why don't we buy something like Coca-Cola, which, everybody's going to keep using during a recession, right? But the problem with that thinking is that TFI is trading at the cheapest multiple it has for a very, very long time. And we've followed and owned TFI stock for, I want to say 20 years now.
Yeah.
They have a very good track record of generating strong, like a lot of free cash flow, even through really bad times. Like they made a lot of money in 2008. They were making money in 2020. And they have a track record of making acquisitions, making really smart acquisitions. So I just think that being worried about whether or not we go into recession over the next year and selling this at a cheap price to go into something that is trading at a much more expensive price, I don't think that's how you're going to end up being successful in investing.
No, I mean, clearly the right approach would have been to sell what was working last year in hindsight and buy those undervalued names. Or maybe more defensive names. However, as researchers, as analysts, we take our time trying to find companies that we want to own. We're looking out 3 to 5 years, right? And so they may be fine businesses, good businesses, but they don't meet our criteria for generating high returns on capital over a multi-year period, especially when their entry point has very expensive compared to the overall market. Clients will ask, what about gold? Gold's the absolute defensive asset, right? Inflation is going up. It's so much uncertainty. The US dollar is going down. Look at the price of gold. You guys are stupid. You're missing it. Shouldn't we get into the gold stocks?
Exactly. Well said.
Yeah. So it isn't easy, of course, in investing to get it right. And I think we talked about it on our last podcast about diversification, that there's going to be companies in your portfolio that are working. And I don't think if you look through your portfolio that you own at Baskin, you'll find that, you have some losers, you have some technology names, but it's not the entirety of your portfolio. And I was on TV today with another portfolio manager, and he said, well, now's not the time to own tech. There's times to own it, and this is not the time, without giving any specific reason. So a lot of people are just acting on sentiment, on vibes. Yep. It's down. Everybody says it's ugly. No one's talking about fundamentals or demand for the products. These are the most liquid names that have been hurt the most, and they can be attacked the most in the short term. And so they obviously will keep going down until they don't. And so that's the challenge for long-term investors is we have to stick to our process. And no, we don't believe this time is different. And that's what the long-term investors approach. They don't think this time is different, but they may think that there are different companies to own it as the environment changes. And that's up to us to come up with better investment ideas that we think will provide better returns in the future.
No, and I think I think a very common question that we get today is what are we, like, back to the original question, is what are we doing to protect investors, right?
Yes.
And I think usually, like, a lot of people would say, well, we'd like to buy defensive stocks, or we'd like to, maybe buy some gold in the portfolio, right?
Maybe I'll short the index.
Yeah. And I think, I don't want to hammer this point too many times, but like, I really believe that the best, if you own high quality businesses, which we've researched like in a lot of detail, like I think we understand the businesses that we own quite well.
Yeah.
That's really the best defense in bad times, because companies that, they're well run, they have a strong balance sheet, they generate a lot of free cash flow. Yeah, like, they might be hurt by whatever's going on in the economy, but they're going to come back stronger because they're smartly managed companies and that's the whole point of having a good management, is to manage through rough times.
So unless you think the world order completely changes and we're never going to use AI again, we're never going to upload any data to the cloud, we're never going to buy new smartphones, then sell everything. I agree with you, but I will take the other side of that bet. We've talked about this before. We buy companies that we think act like tennis balls, right? When tennis balls drop, they tend to bounce back. And so if they're going to bounce back, why in the world would we sell them at a much lower price into a declining, panicky market when we firmly believe that business will recover and probably eke out become even more resilient by maybe making M&A, paying down debt, cutting their costs. These are the offsets that are, they're theoretical. You can't see them until you see them, but we're placing our trust in great management teams that have done this over and over again.
And I think that's really the key. It's the quality of the business and the management team, because you don't want to be the guy who bought Lehman Brothers in 2008, right? You want to have bought JP Morgan, the one run by, the one with the best balance sheet, the one with the best CEO, like the most capitalized balance sheet. You don't want to be the guy who sold Amazon in 2001 just because tech was crashing, right? And you don't want to be the guy who sold Netflix in 2022. But if you had owned, all of the other legacy media competitors instead of Netflix, didn't bounce back. Then it's not a tennis ball.
That's right. So our approach is to own, as Ernest said, quality companies. What does quality mean to us? It means companies that are generally the market leaders, have very little competition, sell a product or service that people can't live without, are run by management that knows how to create value, that uses market opportunities to grow their businesses, that have some kind of geographic or market leadership that that's protected, that there's defense around it. Lots of different reasons. Quality is something that we feel is the best defense in a tough market. Finally, we're business owners, so we're looking at cash flows, right? So the ownership of a stock, I don't care what happened in the past, it's all about the future. You're making a bet on the future. What you're doing is you're hoping that the present value of future cash flows will be worth more than what the stock is trading at today. And so the opportunities happen when the market panics and sells stocks at any price without regard for the future possibly being better than it is today, right? And so everything was hunky-dory a few months ago, pre this Liberation Day. I wish we could take it back. So price targets for companies were much higher, and everybody was excited about the future growth. And then price targets now get cut back because the stocks have fallen so much that it's hard to justify saying, well, I used to think Apple was worth 300, but now that it's trading at 200, it looks ridiculous for me to have a $300 price target in a crappy environment, so I'm going to slice the target price. And that stuff gets the headlines, but things change in investing. So We have to trust our experience. We have to trust our process, and we get everyone's concern. It's not like we're ignoring it. We're concerned too. It doesn't make us feel great. I don't like losing money. Ernest doesn't like losing money, but that's the price we pay for equity investing, is the volatility roller coaster. Sure, we can buy. Sure, we can totally transform our business, right? We can get out of stocks. We can buy bonds. We can buy GICs.
Buy Bitcoin.
We can buy Bitcoin. We can buy gold. I can go give money to third-party managers that are in private assets that don't trade, and maybe that will make all of our clients feel so much better. But that's the wrong thing to do. It's the total wrong thing to do, and we know it 100%. Will we come out of this smelling like roses, and every name that we own today work out perfectly?
Yes.
Yes, we hope so, but it probably won't be the case. But the decisions that we've made in the past of selling stocks into declining markets, giving into client pressure, giving into the biases that are happening now, they've never added any value whatsoever. I wish we would have bought Loblaws for clients, when it was $75, but buying it at $215 or whatever it is today, because it's defensive, doesn't make a lot of sense to us.
And Dollarama.
Yeah. So we may make some trades in the upcoming weeks. We may not make some trades. It doesn't mean we're ignoring what's going on, or, out playing golf. It's too cold anyways to play golf, or sitting there reading books. But we are trying to act more like Warren Buffett and less like an emotional investor, where we try and say we have an opinion about everything. We know what the right thing it is for each government to do, who's the right leader, who's making a mistake, who's not making a mistake. These people were elected, these governments were elected. We have to live with the consequences. We think it's a huge mistake to mix politics and investing.
Well said.
Anything else you want to comment on there?
No, I think one thing I want to point out that might have gone a little under the radar is that I think you did a count across all our client portfolios. I think we have 19 names that are up year to date.
Yeah,
which is kind of, no one talks about these names because they're not moving in the sense that there's no action on them, right? But they're trading at all-time highs. I think they're generally businesses that are not really that impacted by what's going on in the world today.
Yeah.
So something like Waste Connections, for instance, like they collect garbage, right? It's a very good operator. Maybe some impact on like recycling prices and those kinds of things. For
sure, and it is exposed to the energy markets, and when
they have to buy trucks.
And they have to buy, so no one escapes scot-free in a market panic, so to speak. But clearly, there are companies that are much more defensive, much more resilient, or there's other things going on, right? So CoStar is another example. CoStar stock is up year to date. CoStar sells real estate data, as well as owning a number of websites selling advertisements on them for real estate, residential and
apartments.com.
Yeah, you name it. One can imagine that it's probably not the best time for real estate. Hasn't been for a while. Why is the stock up? Well, there's an activists that are in the stock now trying to convince the management to slow down the spending. There's parts of CoStar's business that are cyclical, right? What's the word I'm looking for? That would benefit from downturns as well, right? So it's very hard to make a blanket case. So when someone would call me up and say, well, get rid of all my stocks, that doesn't make sense, because some companies are going to do well in a very volatile environment. And you can see it in our portfolio. Names like Berkshire Hathaway are up. Ernest referenced Waste Connections is up. CoStar is up. You name it. There's a lot more names. The obvious names that are down are the Mag 7. We don't happen to own the two worst offenders, Tesla and NVIDIA this year, but it's not pretty. What any points you want to make about?
No, and again, like that's why we own, like I think 30 or so stocks, is because some of them are going to be doing well and some of them are not going to be doing, like on a fundamental perspective, like at any given point in time due to what's happening in the world. But I think the key is that we think that all of them, like, they're run by really good people and that are positioning their businesses in the right way, and that over time you're going to have a pretty good result.
Yeah. And if we have a bad year this year in the markets, well, we can be happy that the last few years were very strong, and bad years do happen to all investors. We won't be able to get it right or be able to pick. As Warren Buffett says, the market is a voting machine in the short term. It doesn't matter what companies are doing so much. It matters about the sentiment and who's the most attractive and who's the least attractive, right? And so doing that exercise of, well, who's going to be hurt the most in the recession, or which stock is going to go down the most? I mean, easy to do that, but it's in practice. You watch our equity fund, for example, right? And the companies that tend to do the worst in one quarter or 2 quarters then tend to be the outperformers the next 2 quarters later.
It's actually quite surprising how often that's true.
Yeah.
Because every quarter I have to compile the data for regulatory purposes. And usually the worst performer in one quarter is probably the best performer in the next couple of quarters.
Yeah.
And maybe not vice versa, but that's a pretty common theme that I have noticed.
So we're not even going to pretend to tell you how this is going to play out. We're hopeful, of course, that there'll be some resolution negotiations, that China and the U.S. will resume their trade and hopefully become better partners going forward. That certainly was the case after 2018, similar tariff fight. So we're also hopeful that if things do worsen, that there is a number of bullets that the Federal Reserve has, as well as the governments have, to offset some of the pain. You may even start seeing that shortly because markets are very, very volatile here. But we're willing to suffer through the pain. And I think great investors, to borrow a phrase from another investor, have to have the capacity to suffer through down markets. It's just a fact of life in investing. So how do you get around that from a mental, emotional standpoint? Well, I urge you to spend some time looking at the companies that you own in your portfolio if you're a Baskin client. Don't look at necessarily if they're up or down, just look at the names. Take a look at how they've done over the long term. Take a look at why we like them so much. If you want to give us a call and we're happy to walk you through our thesis on all those names. Why would we sell them right now on a date because a client is so nervous, right? It doesn't make sense to us.
No, it would be the easiest thing in the world.
Yeah.
For like if a client says, I don't watch Netflix anymore, I want to sell it.
Yeah.
Right? Like we can sell it. It's not hard for us to do that. But I don't think that would be the right thing for the long-term returns.
No.
Right?
Or your politics, whether you like Trump or the Liberal Party or the Conservative Party, making changes to your portfolio as a result, it may make you personally feel good, but it may be the absolute wrong decision. Only time will tell. But what we want to do is own companies, be business owners, own the best businesses wherever we can find them. And like I said, we haven't made a lot of trades now because visibility is low, but it's possible that we could be more active going forward. One way that clients and those who are looking to reduce the volatility, what can they do?
I think I think what people should do if they are maybe have a shorter time horizon, have a little bit more reason that they can't suffer through a drawdown, they can't see the value of the portfolio falling, is that they can reduce equities.
Yeah.
They can either go to cash. They could increase their bond exposure. Like at Baskin, all the bonds that we buy are high quality liquid bonds.
Yep.
So they protect their value fairly well, at least certainly less volatile than the stock market. So I think that's what you should do, instead of saying, I'm going to switch to like safer stocks, quote unquote, because the reality is there's no such thing, right? And
yeah, I mean, you could say, well, I'm going to fire manager because he's underperforming, and I heard this guy's doing better. But the problem is, of course, you're making the decision at the wrong point in time. I can't tell you how many times we've gotten clients from other managers where they haven't performed well for years, and then they move, and then, either their strategy starts to work or our strategy works better. It's, it really, you can't learn a lot from any one year's performance. And so what we're trying to do is build upon our track record of, this is the process, this is how it works. No question, we're going to get smacked in the face in a volatile market. And
Already have.
We have, but we've been smacked a lot worse.
Yes.
This is a little smack. So we are going to always remain positive, even if we're crying inside, or I want to slam my remote against the TV when I think someone says something really dumb. I'm not going to do that. We respect our clients very much. We respect everybody's opinion very much on the markets. We certainly don't have any of the answers in the short term. I think very few people do. One thing that does annoy me, of course, is people think that there's regime changes based on, 1 week of market movements or some tweets. I think you got to be a little more discerning than that. If it's just as easy for the regime to change because of tweets, it's just as easy for it to go back because of a bunch of other tweets. So that's too hard to know. That's why we don't focus on the macro when making any investment decisions. And I think that's the best place to be. Being positive works for us as investors. That means you focus on the businesses that you own. You get excited to buy more of them when their share prices fall. You get excited to partner with great management teams. You have a belief that over the long term, things will work out. As they generally do. The market will climb that wall of worry. And that's the approach we want to take, we will take, and there's no other avenues that we will take. We're not all of a sudden going to become experts in shorting stocks, using derivatives, buying options. Nope.
Did we talk about that last week?
Did we?
The options?
No.
No, so I think one thing that I'm sometimes asked is, well, why don't I just buy a put option, protect the value of my portfolio, pay, I don't know, let's say 2% of my portfolio to protect against like a 10% decline.
So for people who don't know what the heck Ernest is talking about, a put option is kind of like buying insurance, right?
Yeah.
You're betting that a portion, you're betting that in the short term things could get worse, and so buying some kind of insurance to protect you against that short term drop.
Yeah, and the problem with that logic is, again, because options pricing is fairly efficient in the markets, right? Like the market in times of fear, option prices are expensive.
Yes.
It's expensive to buy insurance when you have cancer, right? Like that's how insurance works. And so what is most likely to happen is that you'll buy the insurance, you don't need it, then you do that for, let's say, a year, and you lost like a third of your portfolio just for the price of the insurance.
Not going to do that, guys.
So I'm not saying like it's always bad to buy insurance, but doing so at a time when you feel like you most need it is probably the worst time to do that as well.
Well, so what we're trying to avoid is letting the market dictate how we should invest.
Yes.
Right? And when we say the market, we really mean emotions. We don't want emotions to dictate how we invest. So when the market's in a bad mood and stocks go down and investors suffer, that's emotional. And then you tend to not think with your brain. You tend to think with your whatever drives your emotions. I guess your brain and your body as well. But people also get physically ill from markets falling, right? They can't sleep. They can't stop looking. They go down the rabbit hole of doom scrolling. They get confirmation bias.
Yep.
The stock market is down today. I know it's going to go down tomorrow. It goes down tomorrow. I'm like, oh my God. It's, those kind of things, right? The other question that I get asked, Ernest, is from an older client standpoint. I'll pick a number. I'm 80 years old. I'm 75 years old. I don't have the time horizon that I did when I was your age, Barry, when I was 50, or Ernest's age, which Ernest is in the 30s, right? I don't have the time horizon. I can't make it up. I'm not working. Well, I think your portfolio was already structured that to be protected in that way when things were going well, right? It's not like we ignored that whatsoever. We probably owned for you, and you own a lot of bonds. We told you to keep cash in your bank account for times like this. So your portfolio is already set up for that. If you found out that you are 100% stocks and that's not right for you, sure, we got to make some changes now. Or is it the right time to do it? Maybe, maybe not. No one knows. But what I would say to clients is those that are every time get worried the market goes down and they're getting older, then don't invest in equities. I don't know what else to tell people, because equities involve day-to-day volatility.
Yep.
Things do smooth out over a number of years, and 1 week, 1 month can't tell you anything about market performance. So this is the approach. We know it works. We don't know how long people are going to live. We don't know how long the bad times are going to last for, but generally speaking, markets tend to do very well over the long term. It's very dumb to bet against stock markets long term.
Very well said.
I've been saying all very well said things today. I'm trying very hard. So we really appreciate all your comments, all your feedback. Clients, we want to hear from you for sure. And, we want to make you feel better the best we can. We'll give you examples of history. Bear markets and volatility don't tend to last very long. And I think a lot of these things that we're going through are reversible. So we're hoping that our things will change. As for the portfolio, the companies that we own, we'll start seeing quarterly earnings. I think in the next few podcasts, we would like to get back to talking about individual companies. As we mentioned in the previous podcast, that's our bread and butter. I have no idea if today's the bottom or tomorrow's the bottom. I would suspect that the news is not going to be pretty going forward for the next few weeks, next few months. That's okay. It doesn't always have to go in a straight line, but we'll talk about our companies, hopefully what they're doing right or wrong, and as the earnings come out, we'll have a better gauge, a better idea of what our companies are doing to adapt to this new environment.
I think it's going to be an interesting couple of weeks for sure.
Yeah, it is. So I don't envy you as an analyst.
No, I think that's no, actually. So I think I actually like reading about these kinds of things more so than is Trump, like looking at what Trump is tweeting on a day-to-day basis.
Yeah.
Right. Because I think it's a little more boots on the ground. It's more interesting to me, and it's a little more relevant to how I think companies are actually reacting to these things, rather than just an overall vibe of like, oh, things are going to hell, right?
So, what we want to see from the companies that we own, if there are outstanding businesses, that they make outstanding decisions in tough times, and they clearly articulate what they're going to do to try and lessen the impact of tariffs and the potential of a recession that may or may not come.
So one thing, for example, TFI International, we talked a little bit about it.
Yeah.
And on the last earnings call, so this was in February, they talked a little bit about what they plan to do over the next couple of years, right? And the CEO said, and I think he's absolutely phenomenal. He's done a great job, Elaine Bedard. He said he understands that when investors tell him, you're a trucking company, you got to play it safe. You got to maintain your balance sheet. You got to be defensive in bad times. But he said, and he gets that, right? But he doesn't want to pass on a great opportunity to make acquisitions to grow the business at attractive prices when he can, even if there's a little bit of risk, right? And there's not a lot, but a few companies in our portfolio that are undertaking have similar mindset, right? Couche-Tard with their proposal of 7-Eleven, right? These are, I think these are extremely shrewd moves, even if there's a little bit of risk that comes with it. But the potential payoff is so great that that's exactly what you want the management to be doing in the company. And hopefully we see a lot more of this.
Yeah, it's very important to keep in mind, of course, when stock prices fall, if they fall faster than the potential cash flows that companies can generate in the future, stocks don't become riskier as a result. They actually become less risky, right?
Yep.
It's counterintuitive, but this is something very important to think about, right? So if the earnings are going to stay stable, but the stock price falls, or the stock price falls 40%, but the earnings outlook only changes by 5%, well, therein is your opportunity. And so these are the things that we're going to be looking for to buy new companies. And our job is to allocate your capital. It isn't to try and predict what the market's going to like or not going to like tomorrow.
Yeah.
It is, and that's the Warren Buffett approach. You don't see Warren Buffett commentating every single day and making grandiose tweets about what he thinks is right or wrong at Harvard University.
He's also like 90 years old.
He probably didn't. I think he tweeted it once, right? Didn't
Yes.
he tweet and say Warren Buffett is in the house?
Yeah.
That was his. And then he tweeted something, I think a few years later, about his charity lunch that he's doing. So probably best.
Did you see he had to issue a press release because there were some AI generated videos of stuff that he said, and he said, "No, that's not me."
Yeah, that's a whole other rabbit hole. Of course, things that people are reading on Twitter, on Instagram, on X, on Facebook, you name it. It's now even hard to discern what is true, what is not true, what's fake news, what's real news. You know, the other day my wife mentioned something. I'm like, I don't think I heard that. She's like, yeah. I mean, I checked other sources and it was completely false. And so you know, you have even these tweets that come out and you think they're coming from the White House can be completely faked and complete baloney, right? So you know, we all have to fact check and verify before we retweet or we use any comments as fact. So it just goes to show how crazy the world has gotten. So Ernest, I think next week we'll start to cover some earnings reports for our companies. I see Netflix is reporting this week. Waste Connections will be reporting. We've had the U.S. banks report. So we'll get into some of this nitty gritty about what companies are saying as these tariffs start to come into play. And so with that, we'll see you back here real soon. And thank you so much for joining us. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.